Welcome to the Gray Report. I'm your host, Spencer Gray, and we've got a lot of stories that are crossing the desk related to multifamily housing, macroeconomy, and just a little bit of politics. We can't avoid it. Two proposals over the weekend. One for a 50-year mortgage on single-family homes. What would the impact be to the housing market, the multifamily market? Is anybody actually asking for this product? But if it did come to fruition, what would that look like? Then also, I feel like I got deja vu back to COVID. The idea of a $2,000 tariff dividend. It sounds a lot like those stimulus checks that went out back in COVID-19 that we all remember very well. I want to talk about some of the consequences that are intended and some of the unintended consequences of those checks back in 2019 and this proposal. But also, we've got some new numbers from CoStar talking again about this slower rental season in 2025 and looking forward into 2026. CoStar's come out with some new forecasts, but also Great Capital. We've got some new internal forecast numbers, a whole new report that we are releasing this week. So you want to check that out. We've got a link to that new report below in the description. Going to be talking about all of that and more. Addison, Lubert, top analyst here at Great Capital. He's sitting in with me. We're going to go all of these articles, talk about the market, see what's going on, a lot more. Stick around, get into it. Welcome back to the Gray Report. Addison, Lubert joining us on the Gray Report once again. You're a veteran of the podcast, been on quite a few times, so folks are going to be familiar with you. How you doing this week, Addison?
I'm doing well. Cold, but I'm doing well.
Yeah, it's winter. Feels like it is finally here in the Midwest. And it's about time because the whole multifamily market has been a little frosty this year. And that's the first thing I wanted to talk to you about. I mean, it impacts your kind of day-to-day here at Great Capital, which, you're consistently underwriting deals, looking at new opportunities, looking at our existing portfolio. And one of the key inputs and metrics for any new acquisition opportunity is rent growth and forecasting that organic rent growth over the next couple of years. And we've been working on our own internal rent growth forecasts for Midwestern markets for 2026. Link to that report in the description below. But CoStar came out with an update to their forecast as well that I wanted to highlight because it was starting to track some similar numbers that we were seeing, but it's not necessarily great. U.S. apartments rent growth declined last month in its largest October drop in more than 15 years as an oversupply of units affects all parts of the country. And specifically, the national average rent fell to $1,708. A 0.3% decrease from September's revised figures of $1,713 marks the fourth consecutive month of no change or negative change in monthly rent, according to CoStar's Apartments.com data. When you're looking at an acquisition opportunity, but you're faced with assumption of flat, call it 1% organic rent growth, but expenses are growing at 2 to 3%, if not more in some cases. You might, conservative assumption might be 3. 2 is kind of the long-standing assumption for inflation. We've obviously seen some prices increase significantly more than that. How do you look at underwriting a deal when there's essentially kind of flat rent growth and expenses are growing faster than rent revenue?
Yeah, I would say, it's been a while since I would say generic rent growth really factors into my day-to-day underwriting, or I shouldn't say generic, but at least above kind of a minimum 3% placeholder. And if there's really rent growth above that, it's, I would say, property specific and very less the broader market.
So just very location specific, but also like business plan.
Yeah, I would say
specific.
location specific. If there's some oddities within the rent roll of, one bed at this square footage is at 1,300, but a different floor plan, still one bed, still same square footage. It's at 1,400. There's sort of a like, let's see what we can do to narrow the gap.
Yeah.
Also taking a look at just where they've been trending on, where they've been signing leases for that floor plan as the year goes on, and trying to maintain a consistent level. But I think as we bring in AIRM and some of the different leasing tools, getting a better understanding of that makes that process is going to make it easier just to understand potentially, hey, how is another owner, how is the current owner viewing the current rent situation. So I would say it's a little bit of, it's mainly that, it's property specific. Another one that I tend to look at also is really the occupancy. When we're seeing properties that are 97, 98, 99% occupied, it's automatically just kind of in our heads of like, well, in any scenario, those rents are going to increase because you don't want to be, if you're sitting at 99, what a lot of people say is like, hey, you're not charging enough.
Yeah.
So it's very property specific. And then I would say if there's any above rent growth beyond that, it's just where it is within the comp set. I think Flats at Stones Crossing was a great example of, you could look at its comp set in terms of what was in the actual town of Greenwood, but you spend enough time in that area, you drive the asset, you know that it's almost like it's, as much as it's a part of a community and it's a part of that comp set, it's kind of on its own as an island. And also factored in there how they were trending on leasing and getting a sense of how the current setup was with new leases. So I would say in general that rent growth is kind of, in terms of where we probably were in 2021 or 2022, if we're getting people up to market, it for the last like year and a half, I would say it's been pretty much, let's see where things are at 3% before we do anything.
So what I'm hearing you saying is, well, one, that there's a lot of nuance in the process. You can't look at, Columbus, Ohio is growing at, forecasted to grow at 2% in 2026. Therefore, what any property that I'm going to be underwriting in Columbus, I'm going to suggest a 2% rent growth. But there can be an individual property story or a location or submarket story. But also, what I heard you say is a mark to market opportunity of where, okay, if that organic rent growth is assuming like all rents are at market. But if a property has rents that are significantly below market, there's more room to be able to push it and still maintain kind of within the range of what the market will accept. So if 1% rent growth is a $20 year over year increase, but if you're $100 below the rest of the comps, true comps already, there may be a whole $110. You might be able to get that asset to, assuming that demographic, is willing to, you might not be able to get that on renewals because maybe someone might think that that's too big of an increase, but on a new lease, theoretically, you should be able to move that full kind of $110 up to market. Is that what you're saying?
Yeah, I would say that. I mean, the other part of it too is you kind of have to think about how we've viewed our own assets and how when we've taken a look, when we've done comp studies and found out, this property near Villas on Fur just moved rent $75 and the spread's tighter than we think it should be. Well, then we start looking at villas and how we could push things up. So
not always is what you're saying. In market rents can be a little deceiving sometimes.
It could be
Did they get one lease at that rate or 0 leases?
Right. So it's that, but also, you can't get in anybody's head, but it's sort of like, okay, well, if they're getting in our heads, it's sort of like if they're getting closer to us, then that means there could be movement for villas or there's going to be an attempt to do it. So kind of factoring in the market of, okay, if we're, the best of the B class and we push rents up to here, you have to think those A class rents are going to start bumping too, because they're thinking, hey, a worse asset's getting closer to us and they're going to push that rent growth. Now I will say on the two things that I also have noticed more and more is not just the actual rent growth number, but what is the actual dollar increase? Yeah. Because 3% in some cases could be $30 to $40. How many people are going to go through the process of moving out of the apartment complex if their rent goes up $30? And of those people that would move out, how many of those people are already kind of trending towards we're buying a house, going to a house to rent? How many of those people would be kind of looking to move anyway? Now, obviously, you don't always have a feel for that component in the underwriting, but the dollar amount now, I feel like probably plays
I agree.
a
Yeah.
bigger role, because like if 3% is an $80 increase, well, how many times can you move rents $80,
Yeah.
especially? And then you start to ask, how many times can the market do that? Or is
Well,
the
and
rest
that's
of the
how
market going
people
to do
think.
that?
They don't think of in percentages. They're not like my rent went up, 3%, 5%, 10%. I mean, some may, but it's usually my rent went up $100, $200. It's
Yeah.
always that nominal amount. Okay, you mentioned AIRM and the dynamic pricing, which I think is an interesting topic when it comes to underwriting or analysis and the way we're viewing the market, because so many more communities are using some form of dynamic pricing versus kind of the old school way was, we set the rents for maybe the year, maybe the quarter, and you kind of set it and forget it. And maybe you're readjusting those on an as needed basis. Again, maybe it's quarterly. But now at many of our communities, our rents are not just changing every day, but but there's optionality within one unit. And so like depending on if you want a 3 month, 6 month, 9 month, 12, 18 month lease, the rental rate is going to change based upon where we want that lease to expire. And so like if taking a an 18-month lease has your lease expire in January, and I don't want that lease to expire in the dead of winter, we might charge a lot for that lease term versus if maybe it's a 9 month or a 12 month and it expires in the middle of the leasing season. Maybe that's exactly when we want it to expire, and we'll give you a little bit of break. But also like when you move in, if you're going to move in tomorrow, we'll give you a better overall rate versus if you want to move in 2 weeks or a month from now.
Yeah.
So that's great for maximizing the efficiency of our rent roll. But then when we go to like look at it from an acquisition standpoint of someone else who's been using those same tools, you could have rental rates are all across the board, and it could lead to inferring a certain rate is achievable when it was a unique situation. How has dynamic pricing, revenue management, AIRM, there's different systems that do it. How is that impacting your process when you're looking at a property?
Well, I will say for this, the further along I would go in the process is really determined in terms of like how close we are in the acquisition.
Yeah.
To guidance.
If we're even like serious enough about the acquisition to go into all the details of how are you operating that system?
Yeah, the closer you are, it's worth it to go through that exercise to figure out just kind of what the patterns are. And what I would say is now the differences now to a degree can be explained through just the different settings that they have it set on. And again, trying to figure out, okay, did this person try and sign a 12-month lease if somebody's coming in July wanting to sign a 12-month lease, it's probably going to be priced favorably than somebody that's wanting to move in January and be expire in January, and how the system's going to treat it. So you're kind of trying to see, okay, there's a variance between, as I'd mentioned earlier, floor plans, same square footage, and yet there's a $300 delta in rents in the same year. What's going on there? And so you're, at least if what's available to you, trying to parse through the rent roll to figure out what's the lease term, what could be some patterns. I would say with the AIRM tools, it can be harder to spot patterns because you don't always know what settings the system was on. Well, I shouldn't say you don't know. And also the settings can change from time to time. If they had higher vacancy a year earlier, those settings change, then they get it right sized to 95. Maybe the market picks up, maybe just ownership management made the right adjustment and they're moving forward. Well, then the settings change. You're going to start to see more variance in the rents, and it's hard to pick the actual patterns. Now, what I will say with Solana, when we did this exercise, there is enough patterns in the rent where starting to try and forecast out what the rent roll could look like the closer we got to close, and it was like, okay, well, if we start taking people to market, all of a sudden they'd be significantly less than what they were at in their current lease rent. So then you're trying to figure out if you're holding them flat or what the situation is. But then it's like, why is this lease significantly higher than what the market is? But then again, same thing. Why is it significantly? So I would say now it's kind of getting out of the sense of you're still trying to find a pattern in the leases, even though I think at this point, the more people that are on AIRM, it's hard to detect a pattern. You're now kind of going more into a mode of what's the degree of variance and what's a high enough variance that you see consistently to say, okay, is this an ARM thing or do they have broader problems?
Yeah, it adds a lot more noise into the process. It's not only, again, your own properties, what you know, but again, what settings did they choose? Are they optimizing for 97% occupancy or 92% occupancy? And then you ask yourself, okay, well, if we change the preferences within the system, just what does that do? And the types of value add. It's not really a value add, but it's how could you generate more revenue by having just better settings on what you're charging? And I think we've seen at least one example recently of where I don't think we're going to be able to be competitive enough on the price. Hopefully we can, but it was starting to be clear that like there may be some inefficiencies just on how they're using the revenue management system. And just if the system was optimized the right way, you don't have to paint any walls or renovate any units. You can literally just change the settings and start achieving more efficient rent in a higher overall total income. Your occupancy may change, but if you achieve a little bit higher rents, you can achieve again higher total net income.
The other thing I will note, and we talked about this a little bit the last time I was on, another big role that kind of plays into, I guess, how you look at rent growth is the concession amount and how they're doing concessions. Because
especially there's a lot of concessions going on right now.
If somebody has a month or two of free rent, you would hope, and more likely is the case that the renter knows that that's not going to be a thing moving forward. And on a 12-month lease, 10 months of paying rent, no discount, and it's at the stated rental rate. You go to do the renewal. Again, that's where that kind of the dollar figure comes in. If it's a dollar amount that they're okay with, they're likely to renew, and you're not going to have really a headache with that. It's where recurring sessions become an issue, because then that's where you're trying to figure out how many people are on recurring concessions, what's that amount, and then where I would try and grow rents the following year. How many people or how much of the property is going to say, hey, well,
that swing, it's not just $100, it's $200, because if they had a $100 concession plus the $100 increase, that's a big swing.
And if there's plenty of properties in the market that are cheaper at the same amount, it's easier for them to make that decision.
Yeah, and most people would underwrite. Okay, I'm going to get some rent growth, and we'll also burn off concessions. Not just we're going to burn off concessions, and then the next year we're going to get rent growth, which is sometimes how it ends up playing out.
I think it's a function of the market, and also just having a better sense now for how the agencies would underwrite. I feel like when I talk with brokers, that's as of now probably the first question I'm getting to consistently is, what's their concession plan?
Yeah.
And is there a set strategy? Like, are they upping concessions now because they have some unexpected vacancy in October, November, December, and they want to try and track the few people that are looking to move during that months, and they want to reach them? Or is it a strategy? Because that's where it's really, one, trying to figure out what the strategy is to communicate to the agencies, but also like, this isn't a recurring thing, is it? And if so, like, is there a plan to get off? Why are they doing it in the first place?
What are some other questions that you're asking brokers now that maybe you hadn't in the past, or you didn't need to, that are unique to the times?
I think to a degree, if there's sort of it really ties into occupancy and economic occupancy. If you see higher than normal vacancy, to a degree, there's just a sense of like, I don't think there's anything wrong with it, but how did they get to a higher than expected vacancy? Was it that they weren't pushing rents, or is there something about the community that people just don't want to leave for?
Yeah.
Trying to get a sense of that. And then really anything that I think it's one of those things. If the more you talk with lenders, the more you can anticipate the questions they're going to ask you. So it's like, I might as well just cut out
get
the
those
middle.
out of the way. Yeah.
And so I think it's if you just really see a pretty high concession or delinquency amount of, okay, how much of this is a pattern, how much of this is just a weird, kind of blip on the radar.
Yeah.
But also that's when you really try and dig into, like, what is the current ownership? What's the current management? Because it's not, the end of the world, but there are some times where you end up with some property management companies where if they're experienced more in workforce housing and they're managing a brand new Class A asset, the strategies just don't align. Or if it's an owner and developer that is more in the affordable space that then goes to market rate, you can see that pop up. So I think it's really trying to figure out the patterns there. And then on the flip side of the occupancy, if they're lower 90s or kind of in the higher 80s, in an otherwise pretty healthy market, that's another one of like, okay, I know I'm going to be told that it's a property management part, but what's going on? Is it that they just don't have a leasing strategy? And also trying to get a feel for ownership. Is ownership not real estate focused? Are they not, I don't want to say, do they not know what's going on, but are they in a situation where they don't even know the questions to ask? Just trying to get a feel of, in general, one, what stories we're going to need to communicate to our investors, but also mainly the lenders are going to ask. So trying to just get that information ahead of time.
Yeah. Well, I want to shift gears a little bit and talk about some of the stories that came across the weekend. The first 50-year mortgage is being proposed. I guess that the story that I read on this is that Bill Pulte, head of the FHA, Federal Housing Authority, former CEO of Pulte Homes or whatever, came into Trump's office in Mar-a-Lago and came in with a couple poster boards. And this was one of the posters, that this image of FDR, President Roosevelt, and then Trump, and next to President Roosevelt, they have 30-year mortgage, and then next to President Trump's picture, 50-year mortgage at the top. It's great American presidents, which again I find humorous because FDR, I can see why Trump likes FDR, but and on one hand we're talking about the evils of socialism, but then we're talking about the Great New Deal and FDR and a lot of kind of more, I use air quotes, socialist policies that I think a lot of people can argue whether they're socialist or not, or they're just, more like welfare policies. Not the point. Any initial thoughts when this came out? I want to go into the details of some of the unintended consequences and also just the practicality and the demand of the 50-year mortgage. There's a lot of opinions. Did you have any initial thoughts when you saw this, or did you think it was real?
Yeah, I mean, my initial thought was more so just the photo. Just the photo with him and Roosevelt. I thought was funny. I mean, for a lot of the same reasons of, like, you couldn't talk about, I guess, like two more different individuals, at least in terms of the presidential sense.
Other than, I mean, I think they both enjoy power, but they're both populist presidents.
Yeah. I think, to me, one thing, I think this came out, or at least I saw the posts around it on Saturday, and in my head it was like, the government is still shut down, correct? Like, this is still.
But this is what we're working on.
Yeah. Like, I mean, I can't blame the administration for, like, okay, we need to think of other stuff going on, but I was like, the government is still indeed shut down.
Yeah. Is this a sign of not being serious about the housing crisis? Or is this do you think this is because I've read that, like, the rest of the White House was not at all read in on any of this proposal, wasn't vetted, wasn't, like, discussed. Is Bill Pulte rolled in with a poster board and Trump's like, that's great, took a picture of it and posted it on Truth Social.
Yeah, I mean, with him being in the political space for, I think, going on 10 years now, for the most part, there are things where it's like, well, he did talk about this, or he has mentioned this, or he has had a weird fixation. This one was surprising because I've never really heard him talk about making massive changes to the mortgage industry. And if so, like one of his complaints, I don't think I've ever heard being, it's not long enough.
He may have made that complaint before.
Okay. So I think, I don't know. I'm not surprised to say that it's a swift, that was a swift decision, but also I definitely don't think it was well thought out. I don't think any meaningful changes are going to, I'm curious to know what meaningful problems are going on in the housing industry in his mind, and how this was going to solve it, or if he even intended this to be like the solution.
Yeah, you'd hope not, because it certainly appears to be more of a more of like a Band-Aid in curing a symptom rather than the problem. And one, it's not even curing the symptom. In fact, it could make the symptom worse over time, because what effectively this does, and we talked about this before we started before we press record. The effect of 50-year mortgage, and whether it's the term or the amortization period, and no one's even got into that type of nuanced discussion. I guess typically residential mortgages, their code, the term and the amortization period are the same. But the effect is like the same when we look at buying a multifamily property. We would love to get a longer amortization period. Oftentimes in multifamily you can get a 30-year amortization. Other types of commercial real estate, it's only 25. And then on like some Fannie and Freddie, but HUD 223F, you can get 35-year amortization periods, which make the the mortgage payment less. And the same reason why we go for interest only, it decreases our we don't have to pay any interest. It lowers that monthly payment that allows us to have higher degrees of cash flow. It's because it's an investment property with a goal of producing cash flow. So from like an investment standpoint, having a low monthly payment where you're going to typically be forcing appreciation to the asset, or hopefully you're buying an asset in a high appreciating market of where you're not relying on amortizing the loan or paying down your mortgage as your primary method to build equity. But for a lot of single family homeowners who are buying it to own and live in, you're not going to be building any equity. Now, it's true that most people still don't live in their home for 30 years. Most people sell their home within, I think, 7 years is the average time someone lives in their home. So it doesn't really matter what the term is, assuming that there's no prepayment penalty. You're just lowering that monthly payment. But if you're lowering that monthly payment, it allows people don't buy based on the purchase price of the home. The primary metric is, what is my monthly payment going to be? What can I afford? And so if you can get that payment lower, that just allows people to buy a house with a higher purchase price, which drives up the cost of housing, so we're going to be back to the same exact level of affordability in very short order, but then it continues to accelerate and homes only become more and more expensive. So the end consequence seems to be we're making the situation worse, not even better.
Yeah, I mean, I would.
Sense.
No, I don't disagree with any of that, and I think I say it's a Democratic policy because I've not heard a Republican push for rent control, but for everything that we talk about with rent control and people in the multifamily industry, I'll say that, okay, that's great, you're capping rents, but expenses are continuing to rise, so you're going to have a lot of landlords that would otherwise exit the space. Also, depending on the jurisdiction, you're going to, de-incentivize people to build, all sorts of that stuff.
Yeah.
And also, the main argument is just like it's not going to do anything. And I think this is, I say this because Trump is a member of the Republican Party. To me, this feels like I don't want to say their attempt at rent control, but their attempt at something that does not address, much like rent control, the fundamental issues of why people are finding their rents or just costs of housing to be out of control.
We need more supply. I mean, this is going to help. Talking or listening to some folks that are in the mortgage industry, more on the debt side. It's who wants to be selling, trading, originating 50-year paper. I mean, 30 years is long enough. 50-year paper is a really, it's a long time, and you might have to potentially because there's so low demand, charge interest rates that are to a level of where it doesn't, that affordability is wiped out anyway.
Yeah.
But it's a product. I mean, the 30-year mortgage, you could often argue, it has been argued, it's really more of a product for banks to sell people. It allows banks to sell more mortgages and more have a product to sell to everyone. And this seems like it's a introduction of another product for banks to sell. And for home builders, it's a loan product that can allow individuals to buy more homes, but those people can already afford to buy a home. Now they can just maybe buy more homes. So I can see why Bill Pulte would be a fan of this, because it's like, hey, more home buying, that's going to be great for Pulte Homes. I'm sure he's divested or it's in a trust or whatever. There's no conflicts, but again, there's got to be a little bit of a conflict there.
Yeah.
I don't see how this helps the consumer or the home buyer or helps the housing industry. And so let's see where Business Insider wrap things up. Why Trump's push for 50-year mortgage could backfire. 3 points. It's not going to help the housing market in the long run. A longer mortgage term might make monthly payments cheaper, but it won't address housing supply, and it could actually backfire pushing up home prices. That's all what we talked about. But yeah, again, and then just, is there an even demand in the mortgage market for this type of product? I don't really think that there is. Any other thoughts on 50-year? My question was, is there going to be a 50-year amortization for multifamily? Because I mean, again, it would have the same impact. On the one hand, you go buy a deal tomorrow, I'll take the lower payment. I'll take a couple more years of interest only for cash flow. But I also know that if I can do that, someone else can do that, and it's just going to increase the price of multifamily.
Yeah, I think there's a lot of the, I guess, concerns that the policymakers have over housing. And depending on what some people say, I think you can tell whether they have a good grasp as to like what's going on with, I guess, with housing, or I guess what's the crunch for people that are trying to buy a home. But in the case of, the 50-year mortgage, somebody on LinkedIn kind of did a breakdown of like, if you did a slightly higher interest rate or what have you, you amortize it, you could be looking at a savings of like $200-$300 a month. And at face value, it's like, well, great, there's savings there, but what is the meaningful amount of affordability for, and how that changes for somebody that gets the $300 a month? What does that allow them to do that they otherwise weren't with the 30-year mortgage? And also, I think it excludes for a lot of people that feel like they can't own a home. Are they making any meaningful adjustments to the down payments and how they feel about that? And also just the other costs of home ownership. Something that I've not understood is when we look at the cost of owning multifamily apartments, we factor in cutting the grass at the property as an operating expense. There's a bunch of expenses to own and maintain the apartments as an operating expense. And yet when people talk to you about why housing is such a great long-term investments, they're talking about, well, you buy it and it appreciates, and 30 years later when you go to sell it, that's where it is. And I get it. People aren't going to keep track of it, but property taxes for us are an operating expense. Homeowners should treat what they pay in property taxes as a homeowner's expense, or as an operating expense.
I mean, I think sometimes, like the mortgage, they'll try to estimate, taxes, insurance, and your principal and interest.
Yeah.
But to your point, there's a lot more costs that go into owning a home, and when you do the analysis of like, okay, can I afford this home? You're taking all of those ongoing operating expenses and all CapEx. It's not being considered at all. It's just, can you pay property taxes, insurance, and your P&I, which is that's what the lender cares about.
Right.
Can you pay enough to, pay me, pay the government, and an insurance company, so if you burn the place down, at least they'll be able to recover it. But if you had to say, hey, we have to, replace, there's going to be, probably $10,000 to $15,000 and, CapEx every single year. Utilities are going to be, $500 a month, just general operating costs, lawn care, trash, all of that's going to be X $100. I think there's a reason why realtors and Redfin and Zillow don't include any of those costs or even estimates for any of those of the true cost of home ownership. And even all the charts, that we see today comparing the cost of home ownership versus the cost of renting, they typically are only including, sometimes just principal and interest, sometimes not even taxes or insurance. Sometimes they might lump all three in, but you're not including, all of those other costs. Where I guess, and to be fair, on renting, there's other costs also. Can be some other fees. You can have, they're not always including utilities, but the potential costs kind of stop there. Whereas, if you own a home, it's kind of uncapped. Well, it's not completely uncapped risk, but you can spend a lot of money pretty quickly.
Well, as I said before, the amount of people that are making up more and more of the workforce, entering the workforce, that are paying off student loans, that already have a monthly payment that they're worried about, and that they're more focused on getting that payment off their backs. How many of those people are like, hey, now that I've got some free cash, I'd finally like to own a car, or I'd like to stop driving the car that I've been driving since high school and make it an upgrade there. And, the Dave Ramseys of the world can say that's stupid. Don't do that. A home is a better purchase. But at the end of the day, that's the decision that people make. And I don't, I think a lot of attempts are at making home costs more manageable and more affordable, or better than just kind of putting our hands up and saying there's nothing we can do, but also a longer amortization term that saves people $200 a month. I would just kind of say, don't be surprised when that doesn't make any meaningful change, if at all.
Yeah, good point. And even Trump himself says there's probably not going to be a whole lot of meaningful changes. He says it's not a big deal. Don't worry about it. It's not. It's just a little bit cheaper. It's a little bit cheaper. It's not a big deal. Okay, so another. The intention wasn't to talk about just a bunch of Trump stuff, but talking about these stimmy checks 2.0, the tariff dividend, which again immediately what I thought of was the stimulus checks that took place during COVID. Was that like $800 a month everybody got? I'm trying to remember exactly what it was for a couple months.
I mean,
it was one time. They did it a couple times. Sent out a couple stimmies.
So I was always under the impression that they were like checks. They were checks meant to cover a period. And then I thought some of the a lot of it was just the recurring costs for the expanded unemployment benefits.
Yeah. I'm just talking about purely the direct payment checks that the Treasury put out there with Donald Trump's large signature.
So I thought there were two of those during Trump's term, and then one of those when part of the COVID relief plan when Biden got in. So I think there was three.
That sounds about right. And they were about $800 a piece, if I recall.
I want to say I think
was it 500.
I want to say the first one was 600. I feel like 600 was a number I remember hearing. And then I remember at one point, I think the second round of Trump's, they were settling on 1,000 and he wanted 2,000.
Mm-hmm. Well, 2,000's back.
Okay. Yeah.
And we don't have COVID-19 to worry about anymore, but we do have tariffs, which this is being proposed as a dividend. It's not tariff relief, but it's a dividend, as in, look how much money your country is making. We're going to send some back to you. But the Committee on a Responsible Federal Budget doesn't necessarily think so. A tariff dividends could cost $600 billion per year. And they've got this nice handy little chart here. If they did the annual $2,000 dividends to individuals, we're basically like doubling the new tariff revenue. And if the new tariff revenue goes away because of the Supreme Court decision, which I think that they can get those tariffs back even if they use another method, it basically is a sixth of the revenue required to pay these dividends. Now, I know there's talk of they're not going to go to everybody. They're just going to go to folks that are not wealthy, that don't need it. I don't exactly know how they're going to do that. Again, because if you go off of like tax returns, like a lot of like wealthy real estate investors don't show a lot of regular income because of depreciation, and so they're in a lower tax bracket. But But also, I thought, though, again, it hasn't really been communicated. I thought we were paying down the deficit with all this tariff revenue, and that was how it was. We were like sort of balancing the big beautiful bill act, and so it's all a little confusing. Other than, is this not just a way to kind of buy the midterms? This is like a midterm strategy, which is not a real estate question, but I mean, it kind of explains this.
I mean, my question seeing this graph was, so is Doge no longer a thing?
I don't think so. So the reason why we're talking all about this, and it's like, what does that have to do with multifamily, is that the stimulus checks were incredibly impactful in a very positive and then a very, very negative way to multifamily back in COVID. When those stimulus checks, prior to those stimulus checks coming in, everyone was wondering if anyone would pay rent because everyone had basically been furloughed or temporarily laid off, and so we were running models to determine how low of collection rates we could achieve to still pay our principal and interest, our mortgage payment. We were like, can we sustain down to 60% collections? The reality is, collections went to almost 100% because before that could be realized, the government started sending these stimulus checks out, and at some of our assets, people were all of a sudden making more money off the stimulus checks than they had at their jobs. And so collections went to nearly 100%. Mm-hmm. People decided to move into some new apartments. So all of a sudden our occupancy went from 95 to 98%. And that then fueled the rent growth that we experienced during 2021 and the first half of 2022. And so that second piece is the unintended consequence is that in the short term, it's like a sugar high. Like it feels really good. Okay, everyone's getting paid. Everyone's happy right now today. But the result, and it's not the stimulus checks did all of it. There was a lot of other spending. There's a lot of other things. We turned the whole economy off. There were supply shortages. The Federal Reserve was continuing to print money. We were quantitative easing while we were doing helicopter money with the stimulus checks. We had PPP, all that stuff. So it wasn't just the stimulus checks, but man, the end up result is we had inflation that we're still, while it's much better today, costs are up significantly, and the consumer, they had to go back. They've spent a lot more over a higher inflation rate in a devalue of the dollar than they got back from those 3 stimulus checks back in COVID.
Yeah. So, I mean, we talked about this the last time that I was on, and since then I've been put onto the phenomenon of how I believe it's the velocity of money, but essentially the measure when they're trying to look at inflation and how they're spending the money. I believe what the term they use is velocity of money.
Mm-hmm. Yeah.
And
how often they get changed hands.
And so, something that was talked about a lot post Great Financial Crisis and throughout the 2010s was there's a lot of concern of the Fed keeps pumping money into the economy, and it's going to lead to a run up in inflation. And because that financial crisis was so bad for many people, or even for some people that maybe didn't get as affected as they probably thought, there's still fears of, I don't know if we're out of this, whatever. It took a long time for people to really start spending the money and getting
the
that
velocity
activity.
of money was near almost nothing.
Whereas
that expansion,
it looks like post COVID, that velocity is much different rate.
Yeah.
And it kind of speaks to what I had said of, I think a lot of people will complain about the economy because stuff got expensive, but their activity's not changing. Mm-hmm. They just don't like that stuff costs more.
Yeah.
But if they're not consuming less of it.
Yeah.
So, I am curious of the.
Let's look at the chart. We're going to look at velocity of M2 money stock because it's a good point, and I'm curious. I just haven't looked at it recently. You see that the velocity of money of M2 is declining, and then basically COVID went to basically zero. Now it accelerated since, basically once we got out of the pandemic. But really, and this is interesting, and I'm sure there's a factor of like rate of growth of velocity of money, not just overall the ratio, but you were basically still below pre-pandemic levels, which is interesting, and it's basically flatlined since Q2 of 2024. We've just stalled. We've stalled out the increase. Now, I guess the question is, and we'll have to bring on an economist to really kind of take us to school. But is the anticipation that velocity continues to decline? Does it kind of just stay here? Are we back in this between the 1960s and 1990? Basically, it was generally it went in a band. It ticked up in the 70s and 80s, and that's certainly related to the inflation that was experienced during that period. But basically from 1997, basically it's been declining ever since, which is fascinating.
So I guess where I am curious on this is like what they are viewing, how the administration is viewing these checks and what they're supposed to mean as opposed to the COVID stimulus that was handed out in how they view it differently than the COVID stimulus that was handed out several years ago. And also what are they anticipating to do? How are they anticipating this to be different?
Yeah. How is it different? Okay. Well, here's another, I saw this post on social media. And I feel like people are going to think I'm like a liberal after this post because it's like or this episode. But so, what's the difference between handing out $2,000, whatever you want to call them, tariff dividends versus free buses in New York? What's more socialist?
Well, I'm glad you bring that up because after Mamdani won,
I'm not for the free buses, by the way.
But I'm glad you brought it up because I think it's the Democrats in 2024 were wondering how, with all the perceived notions of Trump, how people viewed him, the fact that he was president, and the fact that it was viewed by people to be a chaotic presidency, depending on what side of the aisle you were on, how we went back to that. And even then, some of the stuff he was saying during on the campaign trail in 2024, how did America get back to this? And it wasn't just Democrats. I mean, people in Europe were wondering, like, are you guys really doing this again?
Yeah.
But when you read kind of the, what people are saying after the election, it was a sense of there's all this economic uncertainty. We felt like the administration, the Biden administration didn't have a handle on costs. But there's all this talk about people living paycheck to paycheck, affordability, the economy. And then you look at the New York City mayor's race. And there's all these people on the middle and the right that are saying they elected a communist. How did they do this? How did New York get to this point? These voters should be smarter or whatever. And the New Yorkers are coming back and saying it's expensive to live here. The affordability, and rightly or wrongly, we don't know, but they feel that he's they feel like he's the right choice for this.
Yeah.
So you have how people view Trump, and then how people view Mamdani, and anybody looking at the election results, the answer is coming back to affordability.
Yeah.
For widely different candidates.
Yeah.
And granted, I know they're widely different offices, but I would argue the same thing is just like, okay, that you have this constant problem that people are saying in these elections, and yet it seems like you have two different sides that are saying, let's throw just ticky-tack solutions at something that says we did something but doesn't address anything meaningful.
Yeah.
And there's a whole host of things that we could talk about as to like, okay, are these checks really what you want to do as opposed to the long-term solutions?
Again, a lot of Band-Aids versus, treating the symptoms, not addressing the problem. And, it's probably not a coincidence that these two announcements, the 50-year mortgage and the 2,000 dividend, happened within a week of Mondani being elected in New York City, because the underlying reason was affordability. People are they're frustrated that things aren't as affordable as they used to be.
Right.
And if you can go on social media anywhere, in any commentaries, you'll hear people say, all we want is more affordable housing and more affordable health care. We don't really care about like the politics it takes to get us there, but like all we're really looking for in the powers that be, the people that make the big decisions, whoever those are. And this is not me saying this is, whoever. We want to have a more affordable life driven by two primary costs, which are housing and healthcare. And both parties are throwing out, to your point, there's these little tokens like scraps of like, well, here's a couple more years of amortization on your mortgage and $2,000 that we're going, one-time check. You should, thank me later.
Yeah.
Or it's, hey, we're going to provide some free buses, and we'll have a couple locations that you can pick up a couple cans of beans and a grocery store here or there, and we're going to tax individuals in a way that we can't even have the authority to do. It's never going to happen, but we're going to tell you all that we're going to at least to try to do something, but we actually know that we can't do it. And so we're placating to the general public, but there's no actual solutions. Think about this, and again, coming back to multifamily and housing while we're on this podcast, while we're talking about this, but I feel like we have a unique vantage point in terms of housing, because we've watched the market develop over the last several years, and it's something that I think we think about a lot of, but trying to balance. It's a for-profit industry. We're trying to make money, otherwise there'd be no incentive for us to invest into housing and to build more housing and to maintain housing, but also finding ways to make money, but doing it in a way of people can still afford to live in these communities.
Yeah.
Because we can't make any money if people can't afford to live in the communities. So like wages obviously have to be growing at acceptable rates. There has to be a wealth effect for the entire population. But trying to find that balance in the struggle that we have. People talk about landlords. The rents have gone up so much every year. Even including the high rent growth in COVID. Again, if you look at how much expenses have increased between insurance, property taxes, payroll, contract expenses, utilities, we're really not making nearly as much money as most people think. If a lot of people are losing money in this space because expenses have gone up too high, and maybe interest expense because they had a floating rate loan, because we had the stimmies, we created inflation and other actions of the fiscal monetary policy. We're living in this world where it costs more to provide the housing services.
Yeah.
Not that you've got the crystal ball and you've got all the answers, but when you think about it, what are some solutions?
I mean, in general,
you didn't think you were going to come on the show to solve the housing crisis.
No, not.
But now,
not today,
but now we're rising to the moment.
I think it goes back to some of the things. It's only going to be a problem that continues to get kicked down the road until people want to get serious about not just housing, but a lot of our issues.
Mm-hmm.
I think it's a combination of,
start with housing though.
Yeah. So in all seriousness, it's supply. And also I think a lot of, and particularly addressing supply, there's talking about how can you do the tax incentives, and then people not wanting to do tax incentives, or, the affordability restrictions, how you address supply. Even without touching the costs, there's a lot of stuff that I think localities could be doing. I think, listening to, JB Curry there was a NIOP event earlier in the year where he was explaining, one of the issues that they have is you have a seller that wants a commitment in 90 days for you to buy the land to develop on, but there's all this city planning and all this stuff that you have to work on later down the road that's going to take you 2 years, because they have to do their feasibility studies. You have to get community involvement, or community approval, I should say. So they're going to ask you to commit, potentially millions of dollars up front in 90 days, but then you have 2 years to figure out if you can actually build what you think you're going to build. So I don't know how much of it is just, how do states, whether it's a state issue, a city issue, or federal issue of standardizing and moving past some of these approval processes. And I guess what's so frustrating to hear that is scenarios like that is it's not going to take a ton. It's not going to take any money
Yeah,
to
on the
do that.
deregulation part, it's just
Right.
streamlining. Yeah, or yeah, making things more uniform.
And also on top of it, as much as we say deregulation, it's like we're saying like, oh,
Build to fall down.
right. As much as it is like get your approval process figured out. Get it such that if this group wants to buy it 90 days, at least
Yeah.
by the end of that 90-day period when they've bought it, they know we're okay, we can do the development, and now we're beginning that process.
Well, for example, in Indianapolis, there's an announcement they're going to increase the cost of most permits for general building permits, and while first I was like, well, that's for us, that's not good. Why are we increasing the cost of permits? It's going from $300 to $600. It's not like absolutely meaningful. Shouldn't break the bank of most projects, but the reason why they're doing it. I'm not saying that they should increase, but if what they're saying, the reason is true. The reason is right now it can take up to 6 months to get a permit approved in Indianapolis, whereas you go into neighboring counties, it could take 2 weeks. And so when time is money, you have carrying costs. You want to tie up a property, you want to close on a property, you've bought a property, you're trying to build on it. But you have to wait 6 months. That's 6 additional months that someone either has to wait for you to close, which makes holding that property more expensive. You've already bought it and you're having to pay carrying costs, property taxes, and insurance.
Yeah.
6 months. Time is money in this business. And so there's just one specific example of, I don't know if I hope you don't double the permitting fee and then still take 6 months, which is the way government often will operate.
Right.
But that's unacceptable to have to wait that long. There are some municipalities that if there's a time period of if you either deny it or it's assumed to be accepted, and we can move forward with the project. But those types of that type of resistance to building, just makes everything more expensive. And then to have to learn the differences between one county to the next. On the flip side of it all, you want to have local input. And New York City is different from Shelbyville, Indiana, but
In more ways than one.
in more ways than one. But there are ways to make housing more affordable without spending necessarily more money. But then at the same time, again, if you wanted to spend more money, and if you wanted to be, if we're already intervening in the economy and the housing market, which the housing market is very much intervened already, the government's very highly involved. Why not just triple the amount of LIHTC tax credits, create middle income housing tax credits, and just throw a ton of tax credits to develop more supply? Is that overly simplistic? If the answer is more supply, and we already have a mechanism to provide incentives to builders to build, can you do whatever you can on the deregulation front? Which there's going to be a limit to that. There's going to be local home rule that's going to come into play. But you say, look, we're going to double or triple the amount of LIHTC housing credits, and we're going to build another million units, or we're going to build 4 million units of housing over the next 5 years. And developers are going to do it. Developers are going to make money. And that is going to end up being cheaper than dealing with housing inflation over the next 15 to 20 years.
No, I don't.
Why can't we just do that?
I don't disagree, and I think it goes back to the point that J.B. Curry was making of trying to figure out, okay, what, and I'm looking at this from City of Indianapolis' point of view, or at the very least the state of Indiana, of what are the elements of the costs that go into development that are kind of required. I should say kind of required. What are some things that the state could pick up that developers are just more of the nuisance, right? Like, is it the permitting process? What can be reformed? But also, what incentives can be put in place where, I remember when I was here as an intern and was talking with you about how Indianapolis has changed. And there's plenty of these neighborhoods I shouldn't say neighborhoods. You see these houses where it's dilapidated. You're not really sure if somebody owns it, and
Yeah.
it's like, it's causing the city to just, demolish it and just say, hey, it's zoned for anything. It's ready for you to just buy it, build it.
Yeah.
What is the portion that the city and the state can pick up to just say, okay, instead of giving you an incentive, we're just going to clear this hurdle out of the way. And all you guys really need to do is show up, get your plans ready, and build it.
They have done a little bit of that. Like it's like they have like a land bank program, and there have been some pilot programs, but they've always like stayed at the pilot program level, and there's been a few houses here and there, and then the city gets in the way of themselves of like sitting on the properties, not putting them out to market, not cleaning them up, and I agree that they could probably be more involved, and then obviously it complicates it if somebody does typically own something, whether it's an estate or they can't find them, but at what some point can the government come and just take your stuff? I don't know. I mean, if it's abandoned, I'm not sure what the common law is on abandoned property. I'm more familiar with the maritime laws on salvage rights, to be honest.
But I mean, to kind of go back to the initial question asked, I mean, it's a fundamental supply issue, and I don't know what PR campaign either the political parties have to do or the governments have to do, but I think it's time that we need to get I think it's time to really get it in people's minds that the lack of housing supply is, at this point, a national emergency.
Well, they've talked about declaring a national emergency multiple times. It all seems to be more for politics and to say, like, we hear you're really frustrated about the cost of housing, so we're going to acknowledge that you're frustrated, and then here is a solution that is going to not work. But it's going to make enough people talk about it, and it looks like we're doing something. Right. So again, whether it's 50-year mortgages or if it's, again, the deregulation piece and the streamlining, that'll make sense. But like, where's the proposal? Let's do it. And that's what the Biden administration was proposing also. They had multiple memos on housing affordability throughout Biden's term, and most of it was not rent control. It was we need to deregulate a lot of this process. It's one of the few there's true bipartisan consensus on that topic. I really haven't seen. I'm sure on the fringes there are some, but it's pretty darn bipartisan. And again, if people are okay with what the 50-year mortgage or the $2,000 stimmy checks, again, like, I'm not a fan of government intervention in the economy, at all. But while we are intervening, which again there's no way the government could intervene that much more besides just taking over all of housing. We have a tool which are LIHTC tax credits, low income housing tax credits. Yeah. There's been a lot of talk about creating additional tax credits to create more middle income housing tax credits. Mm-hmm. Why don't we just pump up? I mean, the Federal Reserve is fine to start, getting ready to start buying, bonds again and start, sort of, kind of quantitative easing, filling up the balance sheet again. If we're going to be printing money, why can't we print some tax credits and build some housing? Did we solve it?
That, or also, I mean, I've often wondered what burden can governments pick up for a lot of these office conversions? It seems like that's another, I don't want to say bipartisan consensus. Yeah. But it does seem like more and more cities are coming across to some of these neighborhoods, the way that we're thinking of office and just what's going on are changing. And you hear, and I don't, by no means do I want to come across as a huge government interventionist, but what is an area where the government can get involved? Because when we've had conversations with people here in Indianapolis, and I have no reason to believe that this is just an Indianapolis problem, we'd love to look into it, or we've thought about it. It's just too expensive. Changing the layouts, the building systems, and I don't think it's wrong for the government also to look at it and say it's not really cost feasible for us. Yeah, but
the only I think that there's good opportunities there. What I think you just want to be careful is you're not over incentivizing like that strategy. In that there are some office buildings that probably should just be torn down and then purpose built housing is built. Yeah, and so I wouldn't and so that's where the market is very useful, because it's like, okay, what's actually going to pencil here? And maybe the price of that office building just needs to go to zero, so you can just knock it down and build apartments. Now, if you can get some tax credits to build apartments, or maybe you can just get the tax credits for the adaptive reuse on the office building. In some cases, it is going to work.
Yeah.
And we have a lot of office space that is turning, a lot of the older office space, that big question of how it's going to be used. I'm kind of curious. Part of me, and again, I'd really prefer no government intervention. I think if you took a lot of government intervention out, I think a lot of this affordability would not all solve itself. It's not, we live in like a perfect system, but again, a lot of the unaffordability is driven by government intervention. And so it's like, do you want more intervention? The more it, is the medicine hasn't necessarily always been like the cure, and do you take more of it? So that's the challenge. It's just, are you compounding problems? But again, if we're already it seems like we're in this deep, we've got to do something.
Now, another thing that I will add to it, though, is unfortunately, we're at a point where, another component that they talk about and especially as we go into immigration, how this administration is viewing immigration, they're going to be talking about the cost of labor, or we can't find workers. We have a massive trades gap in the country.
Mm-hmm.
And that's another one where it's like, okay, and by no means are you going to fix housing overnight, but there are some long-term things that we need to address that I don't think were around when we were probably building. I think trades were viewed, or at least the population of the country that were in the trades in the 60s, 70s, 80s. I think that was helping spur a lot of the growth than what we're facing now. Because that's another thing that people continue to talk about at events here in Indianapolis and across the country. When you're talking to developers, their biggest thing is cost of labor, the cost to build these, and they're not talking about construction materials.
Yeah.
And if we don't address any of that, you can do all the you can do some of the light tech credits, or you can do some of the zoning credits or whatever to get people
interested. But if you don't address
interested,
how much of it's expensive,
right,
with the cost,
So I just think there's a lot of that. Something that I am concerned about is also, as much as we look at, you have to think, okay, with how out of reach housing and housing supply is or fully moving into houses, and how people are going to be renters for longer.
Yeah.
There's also the worry of, is wage growth, a lot of those components, is that going to allow them to continue to stay on the pace that they're on with rents?
Mm-hmm.
And is there a backsliding in that sense? So, yeah, I mean, it's a shame to see some of the solutions that are proposed, just because, again, as you and I have kind of mentioned throughout the episode, they're all just Band-Aids. And
well, who do you think we are? I mean, obviously, some people are going to take it, full line, and sinker, but they really think we're not that intelligent. I'm not saying that I'm very intelligent, but I'm saying I do know enough about housing that, like, that's not going to necessarily be the solution.
Agreed.
Yeah. Well, Addison, this has been a great episode. We're running out of time. I want to encourage everybody to subscribe to the Great Capital YouTube channel if you haven't done that yet. There's a link below to get access to our latest research report. We just put it out. We're going to do a whole webinar. So click on the link below to get all the information. We do have all these forecasts for Midwestern markets for 2026, going over the multifamily fundamentals from supply, rent growth, vacancy, also giving just some of our kind of proprietary opinions and takeaways on how we see 2026 play out. Some highlights are the Midwest is leading the nation in sustained rent growth, but we're going to see slow growth. But will slow growth lead to better buying opportunities? Distress will drive 2026 deal flow. Supply drops are going to sharpen regional advantages, but then the fundamentals are going to strengthen as costs potentially ease as some efficiencies are found through centralization, AI, and some normalization of costs like insurance and property taxes. So you're going to want to get the full report. The link is in the description below. You're not going to get this information like this any other way. Addison, thanks so much for hopping on the report today. It's a lot of fun.
Always fun to be on.
Awesome. All right. Catch you on the next episode.